Auto giant Stellantis is driving some of its production away from Canada to the U.S.
The tariff and trade war with the U.S. is taking a tough turn for Canada's auto sector.
Stellantis saying it is moving production of its Jeep Compass from Ontario to the United States, and the automaker had previously paused production at that facility in Brampton in response to U.S. President Donald Trump's tariffs.
Something significant has been unfolding in Belvidere, Illinois, and the rest of the country has barely noticed how sharply the ground has shifted beneath it, even though a short time ago the same town was being praised as proof that American manufacturing could rise again. National broadcast praised the revival when Stellantis announced a large multi-billion-dollar investment that would relocate Jeep Compass production from Brampton, Ontario, to Belvidere, and commentators framed it as evidence that a new age of domestic industrial confidence had finally arrived. Crowds heard speeches that promised an era in which factories would return, workers would feel secure, foreign competitors would fall behind, and American labor would stand at the center of global production once more. A story that spread through television, social media, and political rallies until Belvidere was portrayed as a symbol of renewal. Yet, beneath the celebration, conditions shifted in ways that few anticipated, and the story that once felt triumphant began to fracture. A wave of overlapping tariffs pushed the cost of steel, aluminum, and complex electronic parts to levels that had not been seen in a decade, driving expenses so high that the celebration faded almost as quickly as it had begun. Reports from the Anderson Economic Group showed that American automakers paid more than $10 billion in tariff-related costs in 2025, an expense that collided directly with Stellantis, revenues inside the company, financial pressure mounted as profit margins contracted by more than 20%, transportation and logistics costs climbed well above expectations, and the project that had once been portrayed as a showcase of national resurgence became difficult to justify within the company's long-term planning. The public story remained bright for a while, but the internal math told a different tale. And Belvidere slowly turned from a symbol of expansion into a warning sign for what happens when political ambition meets economic reality. That shift became even clearer when Canada entered the picture. A letter obtained by reporters from CTV revealed that Canada's Industry Minister, Melanie Joly, informed Stellantis that its withdrawal from Brampton violated earlier agreements that had tied government financial support to the company's commitment to keep its Canadian operations intact. Her message emphasized that these were not symbolic agreements but legally binding responsibilities tied to public funding, and Canada expected the company to honor every portion of the deal. National and provincial officials stated that any deviation would be treated as a breach, and the government would hold the company accountable through every tool available. From there, the situation darkened. After the media attention faded and the celebratory phase ended, the numbers spoke louder than any speech could. By the second quarter of 2025, Stellantis reported losses approaching $300 million, with a large share linked directly to new tariff burdens, while North American sales dropped by roughly 10%. Manufacturing centers across the Midwest felt the consequences almost immediately. Plants in Kokomo, Indiana, and Detroit announced layoffs that affected more than 900 workers within a short period, and supply chains strained from rising costs as shipments dropped by a quarter. Costs for electronic components rose by more than 40%, the kind of increase that disrupts entire assembly schedules, and plants that once operated with confidence saw their lines slowed or paused, sometimes with large sections left idle for weeks at a time. Even Belvidere, the centerpiece of the earlier celebration, felt the weight of these changes as labor costs rose. Output fell about 18% short of original goals, and over time that had once served as a selling point for workers nearly disappeared. What had started as an example of revival became a case study for how protectionist policies can create short-term political excitement while quietly undermining the industries they intend to defend. Economists referred to the trend as a boomerang effect, describing how policies that appear supportive at the surface can return later with consequences that strike at the very foundation of the system they were supposed to strengthen. Meanwhile, Canada prepared its response with a strategy built on legal structure rather than public posturing. government officials reduced half of the tariff-free quota for vehicles that Stellantis produced in the United States, a move that targeted export margins at a sensitive pressure point and at the same time placed the possibility of legal action on the table if the company failed to maintain its full operational footprint in Canada. That decision signaled a broader philosophy that Joly described as industrial sovereignty, a belief that public investments and national jobs must be protected through enforceable commitments rather than voluntary promises. The approach did not involve loud rhetoric or televised drama. Instead, it sent a message throughout the automotive sector that agreements tied to national funding would be backed by action. As tensions rose in the United States, Canada took another path. Instead of anchoring the conversation in blame, the federal and provincial governments introduced a long-term plan that included a $450 million fund over 3 years designed to retrain nearly 50,000 workers affected by tariffs, restructuring, or shifting production patterns. The plan was not limited to short-term relief, but focused on preparing workers for the growing electric vehicle sector, allowing communities once centered on combustion engine assembly lines to build skills for battery technology, automation systems, and advanced EV manufacturing. Retraining centers began appearing in Windsor, Brampton, and Oshawa, establishing a network that helped transform laid-off workers into technicians and specialists with skills that matched the next generation of automotive production. The broader policy framework involved financial incentives for companies that kept jobs in Canada, along with penalties for those that relocated facilities outside the country, shaping a clear system of rewards and consequences tied to industrial behaviour. Unifor, the largest auto union in Canada, took an active role by monitoring labour standards, validating corporate commitments, and overseeing whether companies receiving public support met their obligations. Through these measures, the language surrounding national industry began to shift. Layoffs were discussed in terms of transitions, closures became opportunities for retooling, and what initially looked like a setback slowly evolved into a plan designed to build long-term strength in a changing global market. While American supply chains struggled to adjust to higher costs and unpredictable sourcing, Canada moved forward with the construction of a more integrated EV ecosystem. At the center of this process stood Nextstar Energy, the joint venture between Stellantis and LG Energy Solution, which committed more than $5 billion to a massive EV battery facility in Windsor. That investment received substantial federal and provincial support, reaching more than $15 billion in combined incentives, and served as Canada's direct response to the American Inflation Reduction Act. Instead of building political momentum through slogans, Canada focused on frameworks that attracted manufacturers with stability and long-term clarity. In St. Thomas, Ontario, Volkswagen's PowerCo division began work on a battery plant supported by about $16.7 billion in governmental assistance, the largest industrial package in the nation's history. Together, the Stellantis LG facility and the Volkswagen plant formed the backbone of a domestic EV supply chain that extended from critical mineral extraction and processing to full-scale battery production and vehicle assembly. These investments encouraged global manufacturers to view Canada as a safer option during a period marked by trade conflict and tariff volatility. As a result, green foreign direct investment grew by nearly half during the first half of 2025, signaling international confidence in Canada's predictable industrial environment. As this momentum built, the contrast between Belvidere and Brampton became greater. Belvidere faced rising costs, supply chain confusion, and investment uncertainty as companies tried to navigate a system filled with overlapping tariffs that analysts referred to as tariff stacking. Production expenses climbed by an average of roughly $2,400 per vehicle in the United States. While auto exports dropped approximately 11%, manufacturers spent more to maintain existing operations, and many found it difficult to plan for the future because expenses shifted too quickly to forecast effectively. Moreover, in other news, the shifting tariff rules introduced under the Trump administration have set off a wave of changes inside the automotive industry, creating an atmosphere in which global manufacturers have started moving their production plans again, and although more developments are likely in the coming years, a sizable amount of redirection has already taken shape. several established brands have begun reshaping their footprint in the United States as they try to adapt to a landscape shaped by rising costs, new incentives, and pressure to build where they sell. And the first signs of this shift are appearing across the country in ways that illustrate how deeply tariff policy can reach into corporate strategy. One of the clearest examples comes from Mercedes-Benz, which plans to expand activity at its Alabama facility by bringing GLC crossover production to the plant by late 2027. A decision that reflects both the appeal of the American SUV market and the need for companies to anchor key models inside tariff-advantaged regions. Volvo has adopted a similar approach as it prepares to add the XC60 plug-in hybrid to its South Carolina plant, a facility that has operated below full capacity for years, and executives have hinted that another model could follow if conditions remain favorable. The company plans to begin American production of the XC60 by the end of 2026, giving the plant a long-awaited opportunity to grow into the role it was originally designed to fill. BMW is moving down the same path, but with even broader ambitions. The company is preparing to expand SUV output in the United States by adding electric versions of the X5, X6, and X7, producing them alongside internal combustion and plug-in hybrid versions, a move that illustrates how BMW intends to maintain flexibility during the transition toward electrification. The Spartanburg factory will also host the new iX3 and likely its companion model, the iX4, while another project, a durable off-road model aimed at competing with the Mercedes G-Wagon, is expected to appear in American production lines by 2029. Larger BMW models will continue to rely on the CLAR platform, while the iX3 and iX4 will adopt the Neue Klasse architecture, revealing how BMW's manufacturing systems allow multiple platforms to flow through a single plant without forcing major operational disruptions. Volkswagen is working toward a broader presence in the United States as well, and its strategy may include expanded American production for both VW and Audi models. Audi is considering the Volkswagen plant in Tennessee or the new Scout facility in South Carolina, which is part of a multi-billion-dollar investment program that aims to establish a strong foothold in the American electric vehicle market. Volkswagen has also floated the idea of balancing tariff expenses with domestic investment by proposing that every dollar spent on American production should reduce its tariff burden by the same amount. And although officials have not endorsed or dismissed the concept, the complexity of tracking compliance remains a major question. The company is also evaluating the United States as a potential export base, hoping that deeper investment could unlock additional support from federal programs designed to reward domestic manufacturing. Japanese automakers have reacted quickly to the new landscape as well. Honda plans to build the next Civic hybrid in Ohio rather than in Mexico, while also expanding CR-V production in Ohio by shifting some output from Canada. At the same time, Honda has reaffirmed its commitment to maintaining Canadian volumes by assigning new export markets to its Ontario operations, ensuring that the plant retains production levels similar to those of previous years. Toyota has taken a comparable route by increasing American RAV4 production while reallocating some Canadian output. And officials have indicated that Canadian factories will remain fully utilized with new market opportunities. Nissan has undergone perhaps the most dramatic transition, reducing its presence in Mexico while raising its American SUV and crossover volumes. Production of the Rogue, that had once been planned for Japan, will now be completed in the United States, and preparations are underway for the return of the Xterra nameplate, which will reappear as a rugged SUV in 2028. The shift has prompted major changes to Nissan's manufacturing network, including the closure of 2 Mexican plants and a complete unwinding of its long-standing manufacturing partnership with Mercedes, which is also selling its stake in Nissan after years of collaboration. The factories closing in Mexico include the Syvac plant in the southern part of the country, Nissan's first international facility, which has produced Frontier pickups and previously supplied vans for GME. It will cease operations by March 2027, with production transferred to the Aguascalientes complex. That's all for today, and if you found this analysis meaningful, subscribe to support more deep dive videos like this.